All right, let's dive right in. Today, we are going deep inside the mind of a master value investor. We're going to unpack a really powerful but surprisingly simple framework for finding incredible bargains that are just hiding in plain sight. And believe it or not, it all kicks off with one single, almost impossible sounding question.
So let me ask you this. Does it even seem possible for a company on the stock market, with its buildings, its products, its entire business, to be valued at less than zero? It sounds crazy, right? It's like someone offering to sell you a dollar bill for 50 cents. You'd think there has to be a catch. Well, guess what? It happens. And understanding why it happens is the absolute key to this whole thing. So let's make this real. Picture it. The year is 2002. The dot-com bubble has just spectacularly burst. And we're looking at this company, MIPS Technologies. They're a semiconductor company, and their stock is just getting hammered, trading at a measly $1.22. Now, to most people, this just looked like another piece of tech wreckage. But for one particular investor, it looked like a mystery that was just begging to be solved. And that investor's name was Bruce Newberg. He was actually speaking in a class taught by the legendary Joel Greenblatt, and he explained how he looked at MIPS. He didn't see it as just a stock chart, he saw it as a kind of crime scene. And what's the first step in any investigation? Well, you put on your detective hat and you go straight for the evidence. In this case, the company's balance sheet. And what he found there, wow. It was the first massive clue. By September of 2003, MIPS was sitting on nearly $74 million in cash. I mean, that is a huge pile of money for a company whose entire value on the stock market was only about $49 million. So what on earth is going on here? This is where it gets just completely wild. Let's break down how absurd this situation really was. MIPS had about 40 million shares out there. So that $74 million in cash worked out to roughly $2 per share. $2! And yet, you could go on the open market and buy a share for just $1.22. Think about that. The market was basically saying, hey, we'll give you $2 in cash, but you also have to take this entire ongoing technology business. But don't worry, we'll actually pay you 78 cents just to take it off our hands. The actual business was being valued at less than zero. It's nuts.
Okay. I know what you're thinking. No deal is ever that good. There has to be a catch, right? There's got to be some hidden debt, some fatal flaw we're missing. The market isn't that stupid, is it? And you know what? You're absolutely right to be skeptical. There was a risk, and it was a pretty obvious one.
Yeah, the company was burning through its cash. A quick look at the balance sheet showed they were losing about $3 million every single quarter. So that big, beautiful pile of cash, it was shrinking. And that was a totally legitimate concern. But was a $3 million quarterly burn really enough to justify that massive a discount? Newberg didn't think so. The math just didn't add up. The real story, the real reason for this crazy price, was hidden somewhere else entirely. And this is the crucial insight. The reason MIPS stock was in the bargain basement had very little to do with how the company was actually performing or even its cash burn. No, the price was being driven down by a powerful, temporary, and totally non-fundamental force in the market. That force has a name. It's called forced selling. And this is a classic special situation that smart value investors are always hunting for. It's what happens when big institutions, like index funds, are forced to sell a stock because of their own internal rules that have nothing to do with whether the company is a good or bad investment. They're not selling because they want to. They're selling because they have to. And poor MIPS was caught in a perfect storm of this exact thing. First, it got kicked out of the S&P 600 small cap index. That meant every single fund that tracked that index had to dump its shares, like yesterday, no matter the price. Second, it was the end of the year, which is prime time for tax loss harvesting, when investors sell their losers to get a tax break. And finally, you have to remember, this was all happening in the grim aftermath of the tech bubble. Nobody wanted to touch a small, money-losing tech company. It created this huge, temporary imbalance, tons and tons of sellers and almost no buyers. And this just perfectly captures Bruce Newberg's core lesson. The absolute best opportunities don't always come from finding the world's greatest company. A lot of the time, they come from finding a pretty decent company that's just being sold off by panicked or distressed or, rule-bound sellers. You are simply taking the other side of what is basically a non-economic decision. So this is a great story, but how do we turn this detective work into something we can actually use, a repeatable framework? Well, the MIPS case isn't just a cool anecdote. It's a playbook you can use to hunt for your own hidden gems.
So here it is. Step 1, you hunt for those situations that create forced selling, things like company spin-offs or index deletions. Step 2, you become that balance sheet detective. Look for the cash, but also check the debt. Step 3, you have to ask why. You absolutely must understand the reason for the cheap price and have a really good argument for why it's only temporary. And step 4, maybe the most important of all, insist on a strong margin of safety. I mean, in the MIPS case, buying $2 of cash for $1.22, that provided a massive margin for error.
But look, even if you have the perfect framework, there is one final piece to this puzzle, and honestly, it's the hardest part for almost every single investor out there, and that is mastering your own psychology. This quote from Newberg just nails it. As an individual investor, you have a massive structural advantage over the pros. You don't have a boss breathing down your neck, demanding you do something. You don't have clients asking why you're holding so much cash. If you can't find a fantastic, no-brainer opportunity, you can do the most powerful thing of all. You can simply do nothing. You can wait. And here's the crucial point. Being busy is not the same thing as making progress. The discipline to say no to hundreds of mediocre ideas and just wait patiently for that one rare pitch right down the middle, that's not just a skill. In the world of investing, that is a superpower.
And that brings us to the end. I mean, the MIPS story happened over 20 years ago, but the forces that created it, fear, greed, and silly institutional rules, they are timeless. They never go away. The same kinds of opportunities are happening right now, today. So the final question is for you. Where is the market overreacting and getting it totally wrong today? The hunt is on.